name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your mid-year 2019 market and economic update. As a quick review of the headlines year to date, we entered 2019 with a lot of uncertainty hanging over the market, such as slowing earnings growth, the Brexit, trade wars on a few fronts, a growing budget deficit, and a Federal Reserve that was looking to raise interest rates amid this backdrop. And I'm sure you recall the end of 2018 was a bit tough, with the S&P 500 dropping nearly 20% in the fourth quarter on these headlines. Well, year to date, we've seen quite a rally in the markets. And so I wanted to give you an update of where we are with some of these headlines. Since then, earnings growth is still likely to slow. A lot of that due to the impact of the tariffs and just where we are in the current business cycle. The Brexit has been kicked down the road. Trade tensions with Mexico have eased, but we are still at a bit of an impasse with China. So that's still something that's out there as a risk to the current expansion. The budget deficit is still a concern, but one of the big things that changed this year, which led to a lot of the rally, is that the Federal Reserve pivoted and is now likely to lower interest rates. And this has allowed the markets, both the equities and fixed income, to have quite a nice year in terms of returns. Here are your returns of your main asset classes through June 30th, 2019. What you can see here is the S&P 500 index, which is the measure of the performance of domestic large cap stocks, are up 18.54% year to date. Small cap stocks, the red bar, is up 16.98%. International and emerging market stocks are up 13.6%, the gray bar. The fixed income markets, as measured by the Barclays Aggregate Bond Index, is up 6.11%. The commodities index is up 5.06%. And this is actually a very unusual return profile. You usually don't see sharp gains in both equities and fixed income at the same time. Fixed income, as shown by the Barclays Aggregate Bond Index there, the blue bar, rises or has a positive return when yields fall. And yields usually fall when there's a risk-off environment or when there is an economic slowdown on the horizon. So that's why they usually don't trade together. Certainly if there's an economic slowdown on the horizon or there's a risk-off environment, usually stocks aren't performing well. But this year, that trend has really been bucked. And it's really because investors have been plowing money into both stocks and bonds on the bet that the Federal Reserve will lower interest rates to boost the economy. So eventually, this will revert back to its normal relationship. And when it does so, that means that either stocks will give up some gains or you'll see a bit of a pullback in your fixed income returns. But which market is going to be right or is going to be correct right now is really a tough call, considering that a lot of the moves year to date have been based on trade rhetoric, which changes often from the administration. And also it's been based on the forecast of interest rates by the Federal Reserve, which has also done a bit of a 180 over the last 6 months or so. And so because a lot of the key drivers of different asset classes, because the outlook is very muddy right now, it's difficult to predict what might happen if you're looking just at the headlines. So what I wanted to do is just give you a quick review of how the economy is actually doing, so you can kind of look past these headlines and make your own assessment. So this is a chart that shows the length of the current economic expansion, and this chart's actually through the end of May, but we have 2 more months of data now. So on the blue bar there, that shows the number of months that we've been in an expansion during different expansionary periods. And clear over on the right, that's the current expansion. As of July, so as of this month, the economic expansion is now 121 months, meaning that the current expansion is the longest in our country's history, which begs the question, are we due for a recession? Well, one important thing to note is that expansions don't die from old age. Just because this has been a long expansion, that does not mean that it is due to turn over and for a recession to occur imminently. Rather, when you look historically, something usually kills an expansion. A lot of times that's asset bubbles or some sort of poor move by the Federal Reserve. So I just wanted to put in context here that even though the expansion has been long, we've had we really haven't had any bubbles that we've noticed so far peak up or pique our attention during the current expansion, like the tech bubble did in the late 1990s, early 2000s, or the real estate bubble of 2007, 2009, which helped cause a recession. And the other reason why it's lasted so long is if you look at the red bars there, this has been the slowest pace of any post-war expansion, with real gross domestic product growing at only a 2.3% annualized rate. So this expansion has been very slow relative to history, and that slow pace is mostly due to increased regulations, low productivity, large changes in demographics as the baby boomer generation retires, and also some ongoing debt issues with the United States. So in this context, the length of the expansion is a little bit less worrisome because the strength of the expansion hasn't been as robust as what we have seen in last periods. And so there is some capacity for the expansion to continue. So what is the current state of the economy? Well, we use a variety of data to gauge the overall health of the economy. And I'm going to focus on two of the data points today: the health of the labor market and the Conference Board's leading economic indicators. So typically, unemployment claims start rising about 6 to 12 months prior to the start of a recession. And recently, jobless claims hit their lowest level since October 1969, which is a 49-year low, which is consistent with continued growth of the economy. It's important to remember that when you're looking at gross domestic product, so growth of the economy, consumer spending accounts for about 2/3 of U.S. economic activity. So the fact that initial jobless claims continue to hover near their lowest level since the late 1960s really reflects strength in the job market, which is critical for our consumption-led economy. And the other indicator I want to talk a little bit about today, we look at many more than this, but here are the two I want to talk about today. The Conference Board's leading economic indicator, or it's also known as the LEI, which is the blue line on this chart, recently reached a new all-time high. And this is important because over the last 60 years, early weakness in the LEI has preceded every recession in the US, with a typical lead time between the peak in the LEI and then the recession ranging between 4 and 21 months. So historically, once that blue line there, once that starts to roll over, then you typically have a lead time of anywhere from 4 to 21 months before a recession begins. So although we do expect this current expansion to continue at the slow pace that it has been on, we do think that the risk of recession, because the leading economic index is so low and because the unemployment claims, the jobless claims are still have such good numbers, that the risk of the recession over the next 12 months it still remains fairly low, probably around a 30% probability of it occurring over the next 12 months. One of the more worrisome signs we're seeing is that the yield curve is beginning to flash warning signs. I talked about that in one of these market update videos over the last few months. That's starting to flash some warning signs. And there are many risks to the outlook, such as a trade war with China that could roll the markets. But the other indicators are still fairly bullish that the economic expansion is likely to continue for at least another year, albeit at a very slow pace, a slower pace than what we typically experience in expansionary periods. And one of the reasons why we like to gauge the probability of a recession is because the stock market tends to peak before a recession starts. Now this chart's from JP Morgan. I know it's kind of busy, so let me just have you zone in on two things here. First is the peak quarter. So when is the peak prior to the recession beginning in terms of economic growth? And then when was the peak of the market? So the related market sell-off column there, the second yellow box. And what you can see here is that this chart shows that the stock market declines going back to 1949. And what you can see is that the market usually peaks and starts to fall a few months before a recession hits. So if you look at that first line there, recession of 1949, the market peaked on June 15th of 1948, and then the recession began in the fourth quarter of 1948. If you look at the Great Recession, so what happened in 2007, 2008, number 11 there near the bottom, the peak of the market was October 2007, but the recession started in the fourth quarter of 2007. So around the same time, but it had a little bit of a lead date. Historically, the steepest stock market declines and the ones that take the longest to recover from coincide with the recession. So we use our outlook for the economy as really a way to gauge when we should start paring back our equity exposure to get more defensive in our strategic portfolios. So currently we're at more of a neutral allocation, reflecting some increased risks given the trade war and where we are in this business cycle. However, the probability of recession is still not high enough to warrant defensive positioning within the portfolios. So overall, the markets have given us a great start to 2019. We are watching the economic indicators closely, and once it looks like the probability of recession has increased materially enough that the market could be peaking soon, we will get more defensive in our strategic portfolios. But until then, we will continue to monitor the situation and make changes as warranted. We thank you for your continued confidence, and please reach out to us with any questions that you may have.